financing decision. For the better understanding purpose, I have divided this entire unit into 4 parts. So we are discussing the part 1, that is sources of finance, and we have 4 types of sources. The first one is equity share or equity capital. Number 2 is preference capital or preferred capital. Number 3 is debt capital, and number 4 is internal sources. In the last class, we have started the discussion about the equity capital. Equity capital is known as owner's capital, and equity shareholders are also known as owner of the company. They get the dividend in terms of return, and they are bearing the risk. That's why they known as owner of the company. And the limited liabilities is limited to that particular number of shares. And after we have discussed the types of capital, there are 5 types of capital: authorized capital, issued capital, subscribed capital, unsubscribed capital, paid up capital, and last one, unpaid up capital. And after we have discussed the different values: par value or face value, issued value, issue value, book value, and market value. And then after we have discussed the rights of equity shares holders, right to income, okay, right about getting the dividend, okay, right to control, right of voting, and right of electing the board of directors, right of preemptive right. Okay, preemptive right means they have a right to get a right shares whenever company go for the issue of additional shares. And last one, right in a liquidation. They have a last chance to get the money. If there is no surplus, they will get the zero amount. Then after we have started or we have completed the discussion about the advantages of equity capital. No compulsory to pay a dividend regularly on a yearly basis or on a every year. No maturity date, no obligation for buyback. Okay, greater ability to get other finance, specifically debt finance, and dividend is tax exempted, tax free in India. It is applicable to India only. Okay, in other countries, dividend is also a taxable income. So please remember, those are international students. Please remember, maybe it happened that in the other countries, in your country, it may happen that the dividend is not tax free. And after the disadvantages or limitation of equity share capital, it's dilute the control of the company. The cost of equity is high. Okay, and the equity dividend is a part of profit. And last one, the cost of issuing the shares or specifically equity shares is higher than the other securities. So this is all about the equity capital that we have discussed in the last class. Are we clear up to this? Yes. So shall we go for the next? Okay, I think so. From this slide, our discussion is pending. Am I right? Okay, so write down the title. Second types of or the second source of finance, preference capital or a preference share capital. This preference share capital is a combination of equity capital and debt capital. It is a combination of equity and debt capital. Why it is combination? Because some of the characteristics of equity shares are there in a preference shares, and some of the characteristics of debt capital are also there in a preference share. Now, can you tell me why this capital is known as a preference capital? Do you have any answer? Why we call it a preference capital? Yes or no, at least. Yes, it's preferred most of the time because they are given a first preference at the time of return. Okay, because of combined characteristics. Okay, yes, very good. All the answers are nearby the right answer. Okay, let me explain clearly. Because they have a right. Okay, there are two reasons. They have a right to get a first preference in terms of return, in terms of dividend, and second, repayment of money at a time of liquidation. That's why this capital is known as a preference capital, because these shareholders have a preference to get a first dividend and to get a first repayment of money. That's why it is known as preference capital. And then after, types of preference capital. I think so. We have discussed this one in your class. No. Okay. So let me explain. Mainly, there are 8 types of preference shares. Okay. There are 8 types of preference shares. Let me start with the number one. One is cumulative preference shares. Can you tell me the your understanding about the word cumulative? Cumulative means hello. इतना डिफिकल्ट क्वेश्चन भी है नहीं. Yes, good. So let me explain. Here, cumulative preference shares means if company declare the dividend regularly, then there is no issue. But if the company skip to declare the dividend, if companies skip to pay the dividend for a particular year, this dividend will be accumulated or stored or carried forward or passed to the next year. Suppose 5% preference shares are there. Okay. So here it means company need to pay a 5% dividend. So every year company need to 5% dividend. If companies keep for a 2020 and 2021, for last 2 years companies will declare the dividend of 5%. So it means when company declare the dividend in 2022, company need to pay a 5%, 5%, 5%, 5%. Total company need to pay a 15% dividend to the preference shareholders. It is known as a cumulative preference share. Are we clear about the concept? Cumulative means accumulation of dividend every year if company not declare the dividend. Reverse to that, opposite to that, non-cumulative preference shares. Raat gayi, baat gayi. If there is a dividend, well and good. If there is no dividend, leave it. No provision to claim the dividend of previous years. If company declare, then welcome, and company not declare, then forget it. So are we clear about the second type? It's very simple. Cumulative preferences means the dividend will come accumulated or cumulated every year. Still the payment of dividend. Non-cumulative means dividend will not cumulated for the next year. If there is a dividend for current year, it will be paid. If there is no dividend, then forget it. Next, number two, participative preferences and non-participative preferences. Here, participative means they have a right to participate in the meetings of the company, specifically annual general meeting. Plus, please here remember one tagline: they have a right to participate. Okay, they can take a part, but preference shareholders does not have a right of voting. The right of voting is only available for equity shares. Okay, they can participate. It means like as our class. Okay, you can participate, you can put messages, but you are not allowed to speak anything except getting permission from the faculty. So it is like as in the equity shares, you also have all the rights. You can speak, you can share a screen, you can put a message, you can take a lecture. But in case of preferences, you just need to listen. You just need to participate. So if the shareholders have a right to participate in the meeting or decision making process of the company. These types of preferences are known as the participative preferences. And if if they does not have a right to participate in the decision making process or in a meetings of the company, they called as a non-participative preference. Again, I clear here they have only participative rights. Okay, they can only participate. The preference shareholders does not have any voting rights. They does not have any right to elect any board of director, or they does not have any right to say something about the decisions of the company. आपको सिर्फ लिसन करना है, आप सिर्फ सुन सकते हो, जो भी हो रहा है आप देख सकते हो. You does not have any right to speak anything or favor or unfavor anything. Are we clear about it? This two one. Okay, good. Now go for the next one. Redeemable preferences and irredeemable preferences. Can you explain me what do you mean by redeemable preferences? Very good, very nice. Okay, it's a very simple. It's very simple. Suppose XYZ companies issue the preferences for the next 10 years, 5% preferences for 10 years. So, after completion of 10 years, XYZ Company Limited again buyback, again redeem that particular shares that called as a redeemable preferences. Your fixed period is there. For that period, company will issue the shares, and after completion of that particular period, company itself buy back the shares. First, they issue because they need a money. Suppose ABC company need 10 lakh rupees for next 5 years. Okay, so they have issued redeemable preference shares for 5 years. So initially they get the 5 lakh rupees from the investors, from the preference shareholders. After completion of 5 years, they return that money. Here for returning, they need to again buy back the shares, preference shares from that particular preference shareholders. So here redeemable preferences means preferences are those type of preferences, those are redeemed after a particular period, or those are buyback by the company after a particular period. And irredeemable preferences means once it is issued for the lifetime. It is issued for a lifelong period. There is no any provision to buy back the shares. Are we clear about the third one? Good. Go ahead. Convertible and non-convertible preferences. It's very simple. Okay. Convertible preferences means preferences having a right that these shares will be converted in a equity shares or in a other securities after a particular period. After a particular period, suppose 3 years, 1 year, 5 years, 10 years. Then it is known as the convertible preferences. Those preferences, those are converted in a equity capital or other securities. Generally we have equity because all the shareholders prefer equity, that's why. And non-convertible means once it is issued as a preference, they remain a preference for the entire life of the company. So are we clear about this, all the types of preferences? Once again, for a quick revision, cumulative in which the dividend is cumulated every year, non-cumulative, there is no provision for accumulating the dividend. If there is dividend, declare it. If there is no dividend, forget it. Participative, they have a right to participate in the meetings of the company. Non-participative, they does not have a right to participate in the meetings of the company. Redeemable, company will buy back that particular shares after a number of certain period or number of years. Irredeemable, once it is issued for the lifelong period. Convertible shares, preferences will be converted in equity shares after a particular time period. And non-convertible means Once it is issued as a preferences, it's remain a preferences for the life period of the company. Now, some of the advantages of the preferences: no legal obligation to pay a dividend. Okay, see here, as per the rule, as per the Companies Act or as per the government, there is no any provision that company need to pay a regular dividend. Okay, that company need to pay a dividend yearly, annually, every year. So this is first of advantages, but there is no any limit legal obligation that you need to pay a dividend every year. In case of debt capital, in case of loan, in case of debentures, you need to pay a interest yearly, annually, by law or by the government or by the as per the provisions of the companies. You need to pay. But in case of dividend, sorry, in case of preferences, no obligation to pay the dividend. No redemption obligation. Okay, except the redeemable preferences, all other preferences are lifelong preferences. There is no any legal rule or a provision that company need to buy back the shares. Okay, after that particular number of years. So there is no tension about the buyback of shares. And number 3, no assets are applied in favor of preference shareholders. If you want to get a home loan, okay, you need to submit some documents of your home to the bank. If you want a vehicle loan, it means you need to plug some documents to that particular bank. That is required in terms of debt capital, but in a preference capital we does not require any mortgage of assets or other securities. Are we clear about the third advantage, जिसको हम कहते हैं गिरवी रखना? तो यहाँ पे कुछ गिरवी नहीं रखना है. Hello everyone, are you with me? Okay, say yes. Okay, only Arju is with me. Okay, Riddhi, very good, very nice. Go ahead. Enhance the credit worthiness of the company. Okay, let me explain this one with a practical question. Oh, sorry, practical example. Suppose I have my own house, I have my factory, I have my own car, and I have one piece of land. And now I am going to a bank and I ask a bank manager that I want or I need a loan for rupees 10 lakh. What is the reply of that bank manager? Yes or no? They grant a loan to me or not? If I have my own house, my own factory, my own car, and piece of land. Okay. Now Mr. X goes to bank. Okay. Now Mr. X goes to bank, and Mr. X having a normal job, and he is earning a 50,000 rupees per month. Okay, and he does not have their own house, he does not have their own car, and even though he does not have any other securities. Now he asks a bank manager, a same bank manager, for a loan for 10 lakh rupees. Can you think, or sorry, do you think that bank manager will grant that 10 lakh rupees loan? Riddhi, are you sure? If the person earning shows is only 150,000 rupees per month salary, and he is demanding a personal loan of 10 lakh rupees without any security, definitely no. Okay, definitely no, because he does not have that credit worthiness. So here my point is only one: if you have that credit score with you, you can get a more finance from the other financial institutes. Similarly, if you have a preference capital in your capital, if you have means if the company have a capital in the preference capital, preference capital in the company of the company, capital of the company, at that time the credit worthiness of the company is more, and company easily get the other finances. Are we clear about the concept? Here, this point is important. So it will improve the credit score of the company. And lastly, as we have discussed that, do not carry voting right. Okay, they have a right to participate if the shares are participative preferences. They have a right to participate in the meetings of the company, but they does not have any voting rights, so they can't dilute the control of the company. Now, next one, some of limitations of preferences. Here, the first limitation is expensive source of finance. Please understand here. Okay, here preferences are more expensive as compared to debt capital, but preferences are less expensive as compared to equity share capital. So if I create a sequence, then the highest expensive source, equity share, then after the second, preferences, and the lowest cost the source of finance is debt capital. Are we clear about the sequence? First, equity, second, preference, and third one, debt. Now, second limitation, no obligation to pay a dividend. Now, see here, same line is here, no obligation to pay dividend as a advantages, and same line is there in a limitation. तो ऐसा कैसे हो सकता है कि एक साइड से आप बोल रहे हो कि ये इसका एडवांटेज है, दूसरी साइड से आप यही कह रहे हो कि सही है, इसकी लिमिटेशन है. Do you have any idea why it is known as a limitation? At least say yes or no. Okay, then tell me why it is called as a limitation. See here, point number 2. We are discussing the limitations of preference capital. Okay, and if you see the advantages of preference capital, first line, no obligation to pay dividend. Same line is there, same point is considered as advantage, same point will be there in limitation. आप एक साइड से बोल रहे हैं कि नो ऑब्लिगेशन ऑफ पे डिविडेंड इज एडवांटेजेस, इन अ सेकंड हैंड, इन अ सेकंड साइड यू आर सेइंग दैट इट इज लिमिटेशन. Okay, let me explain number 1 first. Okay, no obligation to pay dividend means as per the Companies Act, as per the rules, as per the provision, there is no any rule or provision that company have to pay the fixed dividend every year. From that point of view, it is advantage. Are we clear about this one? As per the Companies Act 2013 or as per the company's provision, as per the memorandum of the company, there is no any provision that company need to pay a fixed dividend every year. From that point of view, it is advantages. But see here, no obligation to pay dividend. Here we are discussing as a limitation from the point of view of cumulative preferences. Yes, I agree, and also you agree that there is no any obligation to pay a dividend regularly at a fixed rate. But in case of accumulated preferences, if you are not paying the dividend for the current year, you need to pay the same dividend in the next future years. If you are skipping the dividend for 2020, you need to pay the same dividend in 2021. So from that point of view, it is a limitation. Are we clear about these 2 points? Number 3, limitation. Preference for claim on assets and earning of the company. Okay, as we have discussed, if I want a loan from the bank, I need to plug some assets, okay, in the bank. So if I am going to fail to pay an installment of the company, banks come to my place, okay, and get that asset, sold out that asset, and bank can recover their money. That is applicable in debt capital, because I have mortgaged my asset to a bank. But in case of preference capital, preference shareholders have nothing to claim because company has not mortgaged any assets to the preference shareholders. Just he has issued the preference shares, you have purchased the preference shares, and you are getting the dividend. There is no any security like as though we have in a secured bank loan. Are we clear about the third limitation? That's why this is the limitation. You can't, if company is not going for a dividend declaration, you can't claim, you can't do anything. And last one, acquire voting rights if the companies keep a preference dividend for a certain period. Again, it is applicable to cumulative preference shares. For that type of preference shares, if the companies skip the dividend regularly for next 3 years, 5 years, 10 years, then legally the shareholders can take actions against the company for the payment of dividend. From that point of view, it is a limitation. But if it is in equity shares, equity shareholders can't take any actions against the company not declaring the dividend. So are we clear about the limitations? Again, I repeat quickly, advantages and limitations. Okay. No obligation to pay dividend. Okay. No any fixed provision that a company need to pay a fixed dividend regularly. No obligation to buy back the shares. No assets are pledged in favor of preference shareholders. And it's improved the credit score of the company, and the preference shareholders does not have a voting right. Limitation, expensive source as compared to debt capital. Okay, no obligation to pay dividend, but for a cumulative preference shares, the dividend will be cumulative to the next year. So from that point of view, it is limitation. And here, preference shareholders does not have any pledged assets. So again, it is a limitation for claiming the assets or earning of the company. And as we know that for cumulative preferences, company need to pay a dividend regularly, or if the company is going to fail, if the company skip the dividend, the preference shareholders can find a case against the company to pay the dividend. Now we move for the next one, third one, that is debt capital. Here, debt capital means a borrowed capital. कि अगर हम काठियावाड़ी में उसको कहते हैं तो गुजराती में हम उसको कहते हैं कि गामना पैसे व्यापार करो. क्या कहते हैं? गांव के पैसे से व्यापार करना. Okay, we are running the business by using the other money. We are using other monies to start a business, to operate the business, to run the business. Okay, so it is called as a debt capital, also called as a borrowed capital. We have two types of debt capital. One is a debenture and second one is long-term loans. Let me discuss the first, debentures. Okay, the debentures is an alternative option of long-term loan. Okay, and it is most important instrument to get a long-term debt finance. Before going for the further discussion about the debenture, let me clear one thing. If you see the debenture certificate and equity or a preference share certificate, both are look like same. Only the difference is that debentures holders get the interest, fixed interest every year. Okay, that's why they call as a debt capital. They are considered as a debt capital, and as they does not have any voting rights. They does not have any voting rights. They are getting the interest, fixed interest every year. That's why this considered as a debt capital. In the second head, if you have a equity share certificate, it's getting the dividend. Okay, it's having a right to participate in the decision making. Voting rights are there. That's why it is called as honest capital, and it is called as a borrowed capital or debt capital. Are we clear about the both why the debentures are called as a debt and why the shares are called as a honest? Again, the third point, that is about the risk. Equity shareholders take a risk and debenture holders does not take a risk. In respect to a profit or loss, they are getting the fixed return. They have less concern about the profit or loss of the company. So it is alternative to a long-term loan. It is important instrument to get a long-term debt capital. Okay, debenture holders are creditors of the company. Okay, now this point comes. Already we have discussed. Equity shareholders means owners. These are considered as a creditors of the company, and they have obligation. Okay, they have a right that company need to pay a dividend regularly, and after the completion of particular period, company need to pay the principal amount also. As compared to equity and preference, it is more flexible instrument and offer a variety of choice with respect to maturity, interest rate, uh, repayment, and security. Here, if you see the equity shares, only equity shares. Equity shares means equity shares. Okay, Ram means Ram. Now, if you see the debentures, your debentures means Krishna. If you see the Krishna, a character, he played so many roles. Variety is there. Similarly, we have some varieties in a debentures in terms of maturity. So, let me explain this one with an example. We have generally 6 to 8 types of debentures. Okay, when it's come to a maturity, we have two types of debentures: redeemable debentures and irredeemable debentures. So it's up to a company. Company can issue a redeemable. If company wants redeemable debentures, company can issue the irredeemable debentures. Okay, interest rate. Okay, again this interest rate will be fixed by the company. Company fixed that 5%, 8%, 9%, 12% debentures. Repayment and securities. So these are the options available with the company. Company can go with any option or a combination of different options. So are we clear about the basic funda of debenture? It is alternative to long-term loan. Okay, it is useful for getting the long-term debt. The debenture holders are creditor of the company. They get the amount fixed return in terms of interest, and at the end of the period, they get the principal amount. More flexible and variety of choices there. Now the features of the debentures. Okay, first, all the debentures are act as a trustee. Here, trustee is a person who does not have ownership or who does not have any right to manage the company, to manage the things. Trustee का काम क्या होता है? Trustee, what the trustee do? Trustee just watch the entire function of the company. Okay, trustee put their money, okay, in the company, and thus they are watching that what is going in the company. Similarly, debentures are acting as a trustee. They are just looking to the operations and financial positions of the company. They can't manage a company. They can't be a owner of the company. Are we clear about this feature? Why they are called as a trustee? Okay, please remember equity shareholders are known as owners because they are bearing the risk, while as these debenture holders are known as a trustee of the company. Maybe the question asked in an MCQ question or a mid one that who is a trustee of the company, then debenture holder is the right answer. Okay. Number two, features security. Okay, in debenture holders have a security that in respect of profit they get a fixed rate. Suppose companies issued 8% debentures, it means every year debenture holders will get a 8% interest. There is a fixed security. Next one is interest rate. As we have discussed, interest rate is already fixed. Whenever the company issues the debentures, first company fixed the interest rate, and that interest rate remains same for the whole life of the debenture. Next one is maturity and reduction. Already we have discussed in the last slide that okay, as per the company requirement, company can issue the redeemable debentures or company can issue the irredeemable debentures. And next one is convertible or convertibility. Here again we have two types of debentures: convertible debentures and non-convertible debentures. So it is an important feature of debentures that company may go for a convertible debentures. Here, convertible debentures means debentures will be converted into share capital, specifically equity share capital. Non-convertible means debentures remain debentures. No right to convert the debentures into equity capital. Are we clear about the features? Number one, it is act as a trustee. They have a security in terms of return. Rate of interest remains fixed for all the years. Okay. Maturity and redemption. 2 points: redeemable and irredeemable. Convertibility, convertible and non-convertible. Now the next point of debt capital, term loan. Now I give you a 1 minute. Read the entire slide and you need to explain me this point. Your time start now. Yes, now time is over. Okay, who is going to explain? You may unmute yourself. Quickly, guys. Anybody is ready? Please unmute yourself. If you want to explain. Okay, Prisa said, okay, bank and financial institutes, two types of loan, short term and long term. Okay, good. See, here term loans means a loans specifically provided by the banks, public bank, private bank, and other financial institute. Okay, and generally we have two types of loan. First one is short-term loan, second one is long-term loan. Your short-term loan means loan for less than 1 year, and long-term loan means loan for more than 1 year but less than 10 years. If loan is again for more than 10 years, it is considered as a long-term loan, but the banks are not providing that particular loans. Okay, that loan will be provided by some of financial institutes. Okay, like as Industrial Development Bank of India, IDBI, that bank, or Exim Bank. This type of banks are providing these facilities, okay, for a particular purpose. But generally, in our case, in our syllabus, we have two types. One is short term, less than 1 year. One is long term, more than 1 year but less than 10 years. Here, rate of interest is fixed, okay, and that rate of interest will be fixed by which institute? Can you tell me? bank rates or loan rates will be fixed by RBI. Okay, here the superior authority for all the banks or the financial institute is RBI. So RBI will decide the interest rate here. Okay, uh, if it is for a less than 1 year, it is for a short run. Okay, specifically for one particular objective. If it is for a long run, it is for a multiple objectives. Okay, and generally it is provided by the public finance and public bank and other financial institutes. And last one about the loans, that these loans are paid in installment. Okay, whenever there is a point about the repayment of bank, you need to pay a installment that decided by you and bank, that monthly, quarterly, half yearly or yearly. Generally we have monthly, quarterly and yearly. And one more thing, for acquiring any loan,
Boss, chica, para sus sodas, tenista.
hello everyone, am I audible?
Yes, Raj.
Okay, sorry, disconnected due to the network issue. Okay, so we are discussing the debt capital. In a debt capital, we have term loan, okay, for a short run, for a long run, okay, interest rate fixed by the RBI, then after provided by the financial institutes and bank, and two types, long term and short term, for a 1 year and for a less than, more than 1 year but less than 10 years. Okay. Now the important features, the bank loan will be available in the currency. Okay, if you are getting a loan or if you want a loan in India, you will get a loan in terms of rupees. If you want a loan the other industry in other countries, you will get that loan in that currency. It may in dollar, it may in pounds. Okay. Number two, security. You need to plug or a company need to plug or mortgage one particular asset, as we have discussed. Interest payment and principal amount repayment. As we know that every after a particular period or every month or every 3 months or every year, company need to repay the installment or repay the loan, including the principal amount and amount of interest. These are the simple features we are aware about. So I am skipping directly and moving for the advantages. Now the advantages of debt capital. Okay, here interest is tax deductible. It means interest on a debenture or interest on a loan is tax free. As a dividend is free in the equity shares, here tax debt interest is tax free. No dilution of control. It means here the debenture holders does not have any voting rights. so they can't change the control of the company. Maturity of debt instrument, each and every instrument have a particular maturity date. Suppose 5 years loan, it means 5 years. 10 years loan means 10 years. 1 year loan means 1 year. 5% debentures for next 8 years means 8 years maturity is there. Okay, and as we have discussed in the earlier sessions that the cost of debt is very low. Please remember, cost of equity is very high. Then after second number preference and third one is cost of debt. And already we have discussed that debenture holders are not entitled to what. So these are the advantages: tax free, no dilution in control, maturity is fixed, cost of debt is very low, and they does not have voting right. Some of limitations are also there. Okay, fixed interest and principal repayment obligation. And respective of profit, company need to pay the fixed interest every year. Number two, increase the financial leverage. Okay, it means as you need to pay a fixed interest every year, you require more finance, and as you require more finance, you need to keep some cash, some bank balance with you. So it will increase your financial leverage. In the fourth part of Unit 2, we will discuss practically how we can calculate the financial leverage. Don't worry. And limit the borrowing firm's financial flexibility. Suppose I have taken a loan from the bank to construct the house. Okay, I have taken a home loan. So first I need to complete that particular loan. Then after I can apply for a second home loan. Are you getting my point? So once I need to pay my first loan, then I can go for the second loan. And last one, real cost of debt will be greater than expected. Suppose the bank said 5% interest rate, so that 5% interest rate is there, plus you have some additional charges, plus you have some additional expenses like the submission of required documents, okay, your time, your effort, uh, or other legal charges or other legal fees are there. So this exactly increase the cost of the debt. So there are four limitations. Every year fixed interest will be there. It increase the financial leverage, okay, and your financial flexibility is limited, and real cost of debt is higher as compared to other. Just give me a last minute, okay? I know that we have crossed the time limit. Just give me a last minute, the last slide of this entire minute. Just give me only 1 minute, okay? Then after we will go for a deep dive. Internal sources. Here internal sources means a finance available with the company itself. No need to go for the external sources like equity shares, preference shares, and debt share. We have two sources: retained earning and depreciation. Let me explain both of here. Retained earning means a part of profit that we have not distributed among the shareholders. Suppose company has earned a profit of rupees 10 lakh. Out of 10 lakh, company has declared the dividend for a 4 lakhs, so remaining 6 lakhs is with the company. So this 6 lakhs will be reinvested in the business, and it is called as a retained earning. Okay, so retained earning is a past profit of the company, past net profit of the company. Are we clear about the retained earning? Okay, it's very simple. Past profit plus some reserves that we have created. Next one is a depreciation. Okay, we are in a depreciation. We need to understand 2 points. Number one, depreciation is a non-case expense. As we are charging the depreciation every year on a company on assets, okay, specifically fixed assets. Suppose we have purchased a machinery for rupees 5 lakh, and we are adopted a simple method to calculate the depreciation, and depreciation rate is 10%. So every year company will charge 50,000 rupees as a depreciation. Okay, so 50,000 will be there in a debit side of profit and loss account, but actually this depreciation is non-case expense. Are you agree with me? We are not paying this 50,000 rupees to that machinery. It is a non-case expense. So it means every year we are transferring 50,000 rupees to a particular account, and that account is depreciation reserve or depreciation fund. So from that point of view, it is your internal source. In the future, you can utilize this amount to purchase a new machinery when the old machinery becomes obsolete. So are we clear about these two terms? Retained earning is the past profit, and depreciation is amount that we are transferring every year as a part of depreciation fund or depreciation reserve from the profit itself. अगर हम डेबिट साइड पे उसको लिखते हैं तो इसका मतलब ये होता है कि we are transferring that profit to that particular account. So with this first part is over. In the first part, equity, preference, debt, and internal sources are there. In the next class, we will go for the next unit. Next part, the cost of capital, practical aspect of this unit. Thank you so much for a passionate listening, and have a nice day. Stay safe. Stay at home. Have a nice weekend, and please write your enrollment numbers for attendance purpose, and you are free to leave the class. Okay, some queries are there. Sir sent a message to WhatsApp, kindly respond. Yes, I know, my dear. That is all about that program. Okay, I will respond it. I am searching for the more information. As I get the information, I will update about you.